Good afternoon, ladies and gentlemen, and welcome to the Urban Land Institute of Northwest Arkansas's webinar, Overcoming COVID, Restaurants and Real Estate. I'm your host, Wes Creglow, the Northwest Arkansas Coordinator for the Urban Land Institute. Let's begin today with a few housekeeping notes. First, we are recording this presentation and we will make it available for viewing in the coming days through our website and social media channels. Next, we beg your understanding in the unfortunate event of a technical mishap. If, for example, myself or another presenter loses connection, we will get it restarted within just a few moments. Thank you. Before I introduce our guests for today, please allow me to introduce you to a little bit more about the Urban Land Institute. ULI is the oldest and largest network of cross-disciplinary real estate and land use experts in the world. ULI is our members. Through their dedication to the mission and their shared expertise, the Institute has been able to set standards of excellence in development practice. Established in 1936, the Institute today represents the entire spectrum of the land use and development disciplines. The Institute has long been recognized as one of the most respected sources of objective information on urban planning, growth, and development, thanks in large part to members' knowledge, experience, and active involvement in the organization and their communities. ULI relies heavily on the experience of its members. It is through member involvement and information resources that ULI has been able to set standards of excellence in development practice. District councils deliver the ULI mission at the local level. We engage local members through developing various ULI priority programs, hosting educational forums, and convening special events. And one of those special events is the reason we're all here today. Times have changed and the future is uncertain. In particular, the food and beverage sector of the hospitality industry is undergoing an intensely traumatic period. It has been severely affected and may take some time to recover. Directly related, the commercial real estate investors and managers worry about the level of disruption they can expect to their own industry and for how long it may continue. We will begin this webinar with a keynote presentation followed by a roundtable discussion. After each, the audience will be afforded the opportunity to ask questions to our guests. Please use the Q&A feature found on your screen. We encourage you to periodically scan and upvote any questions you would like to see answered, as that will move them up the list in priority and ensure that we provide exactly the information that most of you want. And without further delay, please allow me to introduce our keynote presenter for the day. Spencer Levy is Chairman of America's Research for CBRE and Senior Economic Advisor for CBRE. He plays an integral role in the development and implementation of the global research strategy and business plan. Mr. Levy oversees the analytical activities of the CBR research community within the Americas region and is responsible for the management of hundreds of professionals who are focused on producing market-leading insight and interpretive analysis on the latest real estate trends. Mr. Levy supports CBRE executives in their decision-making by providing insight into the impact of market trends related to strategic business planning and analyst call preparation. He serves as principal external spokesperson on real estate issues in the Americas region and has considerable media experience, providing market commentary for many national television, newspaper, and internet outlets. Ladies and gentlemen, it is my pleasure to introduce to you Mr. Spencer Levy.
Well, thank you very much, and delighted to be here today. And I will tell you at the outset that my cousin-in-law, Jake Hargraves, is a Little Rock native. So I'm not from there, but I have family that's from there, and he tells me it's a great place, and I hope to visit you one day in person. But speaking about visiting you one day in person, a lot of people have been asking me, well, what have I been doing for the last 8, 9, 10 weeks? And the reality is I've been on the phone like this for 8, 9, 10 weeks all over the world. And somebody said, well, how many people do you talk to? And I said, well, I think about 100,000. And then I added it up and I was actually low. It was closer to 150,000 people. And why am I doing this? I'm doing this because not so I could share my ideas, but so I can hear yours. And hearing yours is yours from all over the world. I've been spoke to my colleague in China this morning. I spoke to my colleague in London this afternoon. And what we're trying to get to is the same place you're trying to get to. When does it end? And what does it look like after it ends? And so let me give you some perspective on that. And I'm going to do it in 3 ways. I'm going to go macro, micro, and then secular shifts. But before I begin, I'm going to give you the two hot topics, the two biggest issues I've been dealing with for the last 8 weeks. Issue number one, I'm too optimistic. Now, what does that mean? I'm going to talk about my macro forecast in a moment. I'm going to tell you about why our shop believes that we're going to be in for a rapid recovery starting in the third quarter, accelerating into next year. But a lot of people disagree with that. And there are people that are in W camps, that are in U camps, L camps. Sometimes I think it's like Sesame Street because we're coming up with every letter in the alphabet to describe it. But that's issue number one I'm going to confront. But issue number two, and what have I been doing for the last 5 days? Well, I was on a call earlier today, is like I have been fighting the fight about the future of office. And I told my colleague, I feel like I'm slaying dragons out there because I'm fighting people in the media. I'm fighting people on the tenant rep side, landlords. Everybody's like, oh, it's over. Well, it's not over, not by a long shot, but nevertheless, that's the battle I've been fighting. So I'm giving you the preview of the two big issues that I'm sure you're going to want to dig deeper into. But let's start with the macro. As I suggested, we are in the optimist camp, the so-called V camp of a terrible downturn in 2Q and a rapid bounce back in 3Q. But even though we're in the optimist camp, we still believe GDP in the United States is going to fall by about 5% in 2020 and go up by about 6% in 2021. So even the optimist guy thinks that we're going to have no growth essentially for 2 years, and we're going to walk into 2022 about where we started 2020. So optimistic is still going to be a tough sled for the next 2 years. But even that tough sled is way better than we were in the GFC and in many places post-tech bubble, post-9/11. But if we were to look at those two time periods, and a lot of people are, you'd reach a, I think, more pessimistic conclusion than we do, because we're looking at what is happening, facts on the ground in China right now. We're looking facts on the ground throughout Asia. And those people are bouncing back a lot faster than people understand. To give you one example of that, I was on the phone with my colleague Henry Chin this morning. He's telling me that office property tours, meaning tours for new tenants that want to lease space, are at 85% of peak today. Foot traffic in the average city in China is higher in half the cities today than it was a year ago. Every Starbucks is open. Every shopping center is open. Industrial capacity is increasing. So things are going pretty good there, but it's not all good. We're not seeing a lot of travel between cities, not seeing a lot of air travel. We're not seeing a lot of major purchases, though I will tell you, he did say they did see an uptick in the sale of automobiles in April. So even that might be improving a little bit. But what's the key to their recovery? Well, it's really two things. It might be 10 things, but I'll give you two. Number one, they've been through this before. Because Asia has dealt with prior crises like SARS and H1N1 and other crises like it, they were prepared. And they were prepared to shut down when necessary and have what we call the 3 T's: testing, tracking, and technology. And if we have the 3 T's, we'll be just fine, or not just fine, but we'll be fine, if that's a way to put it, in the fall when the disease is likely to rear up again. Now, those people who disagree with us believe that the disease is going to get worse in the fall. We're going to have to shut down again. And they are in the, quote, W camp. Well, Mark Zandi, who's the head economist at Moody's, is one of those guys. I was on a phone call with him the other day. Great respect for the guy. The difference between Mark and us is we think that we will not have to go into the massive shutdown again. He has a different point of view. Now, there's real risk that that could happen, but that's where the primary area of difference between us lies. Now, let's go micro for a second, shall we? Let's talk about real estate. Remember I said a moment ago I'm the optimist guy, and I'm also the guy who typically talks about the long-term outlook for real estate. And I'm going to be that guy today too. But for the next couple of minutes, I'm going to be the guy that looks at the next 90 days. Because I believe the next 90 days are the most important 90 days in the history of our industry. And why is that? Because all the people that we do business with, landlords, tenants, they're all lacking the same basic thing: price discovery. They don't know what the value of assets are, and they don't know what rents are. And so because of that, we've seen a material fall off in new leasing activity and capital markets activity until we have price discovery. And what's going to lead to that price discovery? Well, it's when we hit bottom. And the good news, in some areas, we've already hit bottom and are getting better. And that would be in the debt area, where most market participants think we hit bottom in mid-March. And since then, cost of debt has gotten better. More lenders are back in the market, and this is largely because of government support through what they call the TALF program. The same thing has been supporting the rental market because CBRE manages about 7,700 assets in the United States, and we track collections on a daily basis. Now, our April collections were above expectations. We collected well above 90% in office and multifamily, collected about 85% in industrial, but unfortunately, retail was well below the line, averaging about 50%. In some places, like malls, were much lower than that. But actually, those collections were better than we expected. And why? Well, let me give you one good example of that. Our collections in industrial were tracking at about 77% until about 3 days before the end of the month when they spiked up to 84. Why? Well, people paid their rent late. Let me give you one example of that. My wife owns a physical therapy practice right here in Baltimore, Maryland. She didn't pay her April rent until the last day of April when she got a government check from the PPP Payroll Protection Plan. That's a very common story and why collections have exceeded many people's expectations. And you would say the same thing in the multifamily space where people are paying more than we expected because unemployment insurance has been reasonably effective. So that's the good news. Here's the bad news. We're probably not going to hit bottom until June. And quite candidly, I hope we hit bottom in June because what I'm really hoping for is a good June over July comp, meaning that collections in June over July are either flat or July is better than June. At that point, the capital markets will have confidence to transact more. People will have more confidence to deal with what is market rent. Now, in the interim, what people are doing to try to get through this period is they're on the capital market side creating cash flow escrows to collect rent for the next 2 years, not knowing what it's going to be, and putting that aside and bleeding it down in a fund. Or on the rent side, on the leasing side, people are putting together market rent reset provisions so that tenants have the ability to reset rents in 2 years because they don't know what market rent is today. But what are most tenants doing today? They're doing short-term extensions in place for two reasons. One, they don't know what the future is going to hold. And the second thing is if they're going to move, even if a landlord gives an attractive tenant improvement allowance package, the tenant still needs to have to come out of pocket a lot for TIs, and they don't want to spend those dollars today. So most people, short-term extensions in place for the time being. And, that may last for some time. And why is that? Because this takes me to the point of the conversation where I now want to look a little bit more out into the future, into what is our forecast for the 5 major asset classes. Well, to do that, we've broken them into what we call a 1, 2, 3 scenario. 1, which asset types are going to come back after 1 year? That's multifamily and industrial. After 2 years, that's office. And after 3, that's retail and hotels. Now, we just came out with our forecast for multifamily a couple of weeks ago, and we think multifamily rents are going to fall about 8% over the course of 2020. Vacancies are going to increase about 6%, but they're all going to start declining in 2021. Same thing in industrial, but industrial, one size does not fit all. Because even though our collections were around 85%, Prologis and some of the large REITs were much higher than that because they have a disproportionate amount of their portfolios that are in large warehouses, big box. We have a disproportionate amount in ours that is flex industrial, and flex industrial is not going to perform as well. And what is flex industrial? That's small bay, has smaller contractors, and some small businesses that are going to be tough to restart at full capacity until we get past this crisis. One of those small businesses is jump houses, and anybody on this call who has a child or a grandchild has been to one of these jump houses. Those are in flex industrial. They're going to have a real tough go of it for the next period of time, trying to get reopened and being opened at capacity. Now, multifamily, while we're optimistic about the year, there's also shades of gray there for different types of multifamily, particularly once you delve into senior housing and into student housing, which are clearly going to take longer. But once we're past this crisis, the future is bright for both of those as well. Now, in the 2 camp is office. And as I said at the outset here, I've been slaying 2 dragons over the last few months, and particularly in the last couple of weeks. One is that I'm too optimistic. And the second is that office is dead and nobody's coming back, right? Well, I don't believe that. And I'll tell you why I don't believe that. Well, let me start with a comp. And it's tough to talk about this comp, but you got to talk about this comp, which is the 9/11 comp. Because after 9/11, many people were afraid to go back into the big cities, New York, DC, LA, San Fran. And in addition, people were afraid to go into tall buildings There was a period of time, in fact, in New York City where the rents that were being charged for lower floors were higher than the rents for the higher floors. But what happened? What changed? What changed was they increased the security in these buildings so that people got more confident, and people went back into New York in greater force than they ever did before. Same thing happened post-Hurricane Sandy, which destroyed much of the critical infrastructure in downtown Manhattan, caused better building standards, and the buildings became more resilient. The same thing's going to happen today as buildings are going to upgrade their so-called wellness standards to be a similar level of importance as security for 9/11, as resilience was for Hurricane Sandy, and as sustainability or green initiatives have been for the last 10 years. Once we have this wellness in place, people are going to go back to the office. And why are people going to go back to the office? Well, based on every study we've done for the last 10 years, people don't go into the office because they, quote, need to go to the office. They go there because they want to. And why do you want to go to the office? I'll tell you why you want to go to the office. Because all of our studies show that people are happier, they're more productive, you can attract and retain talent, and you can create the culture that your company wants to create in a traditional office environment. Now, are you going to see a rise of what we call the fluid workplace? Yeah. You know, we wrote a report 3 months ago called the 2030 report, The Age of Responsive Real Estate, which talked all about the fluid workplace. And what is the fluid workplace? The fluid workplace is you can work from home. You can work from a Starbucks. You could work from a traditional office. One day you could work from the back of a self-driving car. And that's going to increase. And that was probably accelerated. And what accelerated it wasn't just COVID-19. It was also generational changes. Millennials are now at a different life stage than they were 5 years ago when everybody wanted to work in a very dense co-working environment. They want some flex work too because they're married and disproportionately now have kids. That is the biggest changer about wanting to have some flexibility in your schedule, in addition to the technological changes that now make it more possible today than perhaps ever before. But starting once this crisis has passed, people are going to go back into the offices. We might have less density, meaning more square footage for the average employee, and the wellness standards are going to increase. And that's not just going to be things like hand sanitizers and better janitorial services. It's also going to be better HVAC in your building. I was on a CNN event yesterday, and the guy was talking about how he zaps his air coming out of his HVAC with ultraviolet light. I have a client in Southern California building a $500 million office building. The client's called McCarthy Cook, and the office buildings in West Hollywood. He's putting into it what he calls hydronic HVAC. And what is that? That's pumping hot and cold water into your walls and into your floors rather than pumping forced air in there, which is more expensive, but it's cleaner. And why would you pay that extra cost? I'll tell you why you're going to pay that extra cost. I'll give you a case study. One of my clients is building an office building in Portland, Oregon, 12 stories, and he's framing it with wood, not steel. Costs him 15% more. Why would he do that? Well, I'll tell you why he's doing that. Because he correctly assumed that the tenant demand to be in a greener building from a building material standpoint will enhance demand. And he was right. So even though the materials cost him 10 to 15% more to build this 12-story wood-framed office building, he's more than making it up in enhanced tenant demand in terms of tenants and the rents that they're paying. It's going to be exactly the same thing from a wellness standpoint. Now, might there be less people in the office? Marginally, yes. But they might have also marginally more square footage per person, which could potentially balance each other out. Now, in the short term, you are going to see some changes in the next 12 to 18 months. And the changes in the next 12 to 18 months are going to favor not only suburban over dense urban environments. And the reason for that is there are going to be challenges in dense urban environments, both related to transit. How do you get to and from your house to the office? But also the transit within the building. Going up these elevators, you can't get in line and get everybody into the building. As a matter of fact, a colleague of mine and I were talking about Salesforce Tower in San Francisco, the tallest building in the Western United States. They said that if you were to implement social distancing and tried to get everybody into the elevators, you'd have to have a line out the door 2.5 miles long to get everybody into the building. Guess what? It ain't going to happen in the short term, and you're going to have a materially reduced occupancy in the short term. Now, the other thing that's going to hit office in the short term is we've seen an increase in sublet space. And this is in markets like San Francisco, which surprised me. San Francisco is actually showing more sublet issues than is New York. You also have, of course, the co-working or flex space problem, where we are likely to see a fallout in that space as well. Now, that doesn't mean we don't like co-working or flex work in the future. In fact, I like it more today than I did yesterday, because I think it's proven why it's important for Fortune 500 companies to have this type of flexible space as part of their portfolio. We call it the hub and spoke model. That's a new term du jour, but I like it because it's true. Big companies are going to have their CBD offices, but they're going to have these satellite offices in these suburban areas around it to give their workers flexibility. What you might also see, and this is relevant to Arkansas, Little Rock, it's relevant because people are now going to allow more workers to work in smaller markets like a Little Rock to service companies that might have headquarters in New York, San Francisco, or elsewhere. So in the short term, at least in the short term, if not beyond, the pendulum is swinging in favor of smaller cities and suburban environments. Longer term, the trends as it relates to the bigger cities and CBDs are likely to prevail. But strike while the iron is hot, and the iron is hot today for suburban and smaller markets. Now, in the 3 category, we have retail and hotels. Now, we all know some of the headline issues regarding retail, where we've seen some of the big box retailers like JCPenney, Neiman Marcus, J.Crew file for bankruptcy. I don't think anybody was surprised about any of those things, any more than people were surprised about secondary market malls, secondary market power centers struggling. That was an acceleration of a trend that was already happening. But the new trend that happened is the so-called experience retail, the restaurants, the gyms, the bowling alleys. They're now suffering because of social distancing. And that's going to continue for the next 12 to 18 months. And the good news is we've gotten a lot of government support so far. The bad news is, or the real hope here, is we need a whole lot more now, because according to the National Restaurant Association, at least 15% of these restaurants are never going to reopen. And that's before you talk about a lot of the small shop space, which is also going to suffer. So I guess the good news is that I'm on the phone with the ICSC, the Real Estate Roundtable, ULI, NAIOP, MBA, every single day lobbying to try to get more support into our industry, and we think more is coming. The one area that's of the greatest stress in retail isn't just operational, it's capital markets, because about 30% of all CMBS or conduit loans are in the retail arena, and they are the least flexible type of loan when it comes to the ability to pay back or to get flexibility from your lender. So that's going to be a real challenge. We're working on it, but right now there's no particular hope on the horizon for that. But for other types of lenders, there is a lot of hope. So I'll give you one example of that. One of my clients is a big German bank, and they have $8 billion of loans here in the United States, $5 billion of which is in hotels and in malls. You can imagine with that kind of loan book, you've been pretty busy over the last few weeks. But what have they done? They gave covenant relief, meaning that the borrower does not have to hit their financial targets until the end of 2021. They've essentially mothballed the assets for 2 years. And this is with the explicit guidance of the ECB, European Central Bank, that supervises them. You're seeing similar guidance being given, starting with Fannie Mae and Freddie Mac, that have given forbearance relief to borrowers. Some banks are giving similar relief under the guise of the FDIC, and insurance companies are doing some of the same thing, which is why I was on a call earlier today and people say, well, when are the distressed deals coming out? And I'm like, I don't know. And maybe never. I wouldn't say never, because there are going to be some deals that have already come out, but maybe at a much lower volume than you think, because the regulators are much more accommodating today than they've ever been in the past to give borrowers relief, number one. And number two, here's the wild card. What's a bankruptcy judge going to say when you walk into court 4 months from now and a lender tries to squeeze a landlord? I don't think that bankruptcy judge is going to be that good, that accommodating if that landlord was acting in good faith. So all of these things are conspiring to me to believe that we're not going to see nearly as much distress now as we have in prior crises, but it also defends my position on the V, on the optimistic recovery, because we have bounced back so quickly from a capital markets perspective, at least the cost of debt, at least the support that's given to borrowers. That gives me optimism about that. Now, the last thing I'm going to mention is hotels. And the hotel space has to be segregated between those hotels that are so-called staycation or drive-to hotels, those that cater to international travelers, and those hotels that cater to the business traveler. The staycation hotels are going to bounce back quick. And I know that because we're already seeing that bounce back in China. We're already seeing that bounce back in Texas, where we have seen some hotels that have recently reopened on the coast had 90% or above occupancy this past weekend. And then I know exhibit 3 is yours truly. My son plays travel baseball, and they are playing a tournament in South Carolina about 8 hours from here in the first weekend of June. Not only am I going, but I'm making a road trip out of it, and I'm hitting a couple of fancy golf hotels on the way down too. Why? Pent up demand. And where else are you seeing this pent up demand? You are seeing it in restaurants. So a client of mine who was on my podcast last week just reopened his restaurant in Houston. And he can only operate at 25% capacity today due to local restrictions. But I asked him, how you doing? He said, well, we're doing 50% of revenues, 25% occupancy, 50% revenues. And I said, well, how's tipping? He said, more than double normal from a percentage basis. So we've got not only pent up demand to buy, we've got a kumbaya spirit that we're all in this together, and people are willing to work together to get through this faster. Let me go one step further. I was on a phone call this morning with my global chief economist, and he says, I don't think these airlines are coming back for 5, 6, 7 years. And I said, no, they're going to come back a lot faster than that. Why? Pent up demand, and hotels and airlines have pricing power. They can literally price their product down to zero. I was going to when I'm taking a look at my road trip to South Carolina, I looked at the price to fly to Charlotte, $50. I might get on a plane. You know what else is going to come back? Cruise ships. You know why? Because going on a cruise ship is awesome. And you know what's more awesome than that? Going on a cruise ship cheaply. And they can price down the cruise. People will get on that cruise happily. So I hate to use an old 1980s expression, but I'm not saying that greed is good, but greed works. Pricing power motivates the average consumer, and that goes right down to Gen Z consumers. I'll tell you about a study that happened last year with the ICSC. They studied Gen Zers and what were their shopping habits. Why do they buy stuff in a mall? And by the way, Gen Zers are the #1 age cohort in malls. And a lot of people, when they hear that question, would say, oh, yeah, social consciousness, environmental, something like that's going to be their #1 motivation. You'd be wrong, because that came in last. What came in #1 was value. And I mean cost. I mean price. Pricing power will drive the economy back forward faster than you think. You combine that with pent-up demand, and then you get some marginal improvement in the course of the disease, we will bounce back faster. That's why I'm in the optimist camp. So let me sum up my comments like this, and then I'll take whatever comments the good people of Arkansas have. We believe that it's going to be a very tough sled for the next quarter, but we'll bounce back over the next 2 years. We believe in the 1, 2, 3 scenario for real estate. 1, industrial and multifamily coming back first. 2, office. 3, we believe in retail and hotels. We believe that those people who are writing the death knell of office have jumped the gun. People don't go into the office because they need to. They go there because they want to. And those want factors are never more important than they are today. Attracting talent, productivity, happiness, collaboration. These things are enormously important. And while these Zoom calls work in the short term, they don't work in the long term for those types of factors. So with that, thank you very much for the opportunity. I'm a big fan of ULI and my cousin's from Little Rock, Arkansas, and I'm delighted to take whatever questions you got.
Great. Thank you so much, Spencer. Very, very meaningful content there. Certainly appreciate all the preparation that goes in to your remarks like that, and the value that it provides every audience to which you present. So let me start by saying thank you. Looking at some questions, we got one rolling in here. Looks like I'll just read it verbatim here and pitch it your way and see what your thoughts are. In our market, we're seeing local and regional banks offering 90-day forbearance, with landlords offering free and reduced rent concessions to tenants, perhaps extending leases by a corresponding 90 days at the end of the lease. How widespread is that practice to you, to your knowledge nationally, and how do you see it as evolving as we reach the 90-day mark since the beginning of the pandemic?
Well, I see it as very widespread, and I think it's certainly most noticeable in the retail arena, but we are seeing that in the office arena and secondarily the industrial arena as well. And what's really happening is landlords are two ends of the spectrum, right? On one end of the spectrum are landlords that are saying, these are the terms of our lease. This is not force majeure. You've got to pay. And then we have at the other end of the spectrum, landlords are like, they give you forbearance before you even ask for it. But what's happening with most landlords is they're taking it on a case-by-case basis with tenants to try to understand their individual financial circumstances and trying to come out with a reasonable accommodation to get them through this period, some of which is what you just described, Wes, where people are giving these 90 days forbearance, tacking it on to the back of the lease, tacking it on the 2021 rent. We're also seeing in many retail tenants, particularly in restaurants, putting in percentage rent over the short term rather than paying fixed rent until they can get back on their feet again. So we're seeing a lot of these accommodations, but what many of our landlords are doing is they're asking, number one, to see the P&L of the tenant to see what their actual distress is. And number two, many of our landlords are requiring that before a tenant can ask for forbearance, they need to apply for an SBA loan.
Great, thank you. Another question at you, Spencer. Do you see a new type of lease structure for retail tenants emerging in the long term?
Boy, tell that listener, that's a great question because I wrote a blog about that last year. And the blog I wrote about it was called New Rent. And what is new rent? Well, we all know what rent is. There's base rent, and then there's percentage rent. But new rent is a new category of rent. And that new category of rent is percentage of trade sales in the region on the internet. So that's a third brand spanking new category there where you are true partners with the tenant in terms of their sales because your bricks and mortar store is a form of advertisement to create more foot traffic in the area. That's why you see so many of these so-called clicks to bricks. Like Warby Parker was at the forefront. All internet opened up a store because they realized it drove sales. So I absolutely do see a new rent structure forming. You might also see shorter term leases, which I know is burns the ears of everybody that hears that on this call. But don't fear it because it's already happened around the world. It happened in London. The average lease in London went from 15 years to 7 years. Their cap rates are among the lowest in the world. Singapore's average retail lease is 2 years long. And the capital markets will adjust. But for all of the good people on this phone call that are appraisers or bankers, they're going to be a little bit late to that barbecue because ultimately long-term leases with credit tenants is still how most people underwrite deals. But I do, to your question and the caller, go to my LinkedIn page and see my blog called New Rent. You can learn more about it. But yes, I do see a change in lease structures for many retail tenants having these three components: base, percentage, and this trade area internet sales rent moving forward.
Great, thank you. So a little bit of background here in Northwest Arkansas, we have 3 Fortune 500 companies and a whole host of other significant corporate employers. And we are one of the fastest growing metropolitan areas under 1 million in the country. We're very proud of our growth here, and it's very high quality growth, and it appears that the future is limitless, but obviously in these moments, it kind of shakes us a little bit. An audience member here would like your thoughts on how Northwest Arkansas developers will look forward into 2022 and 2023 in terms of growth relative to other metropolitan areas. I feel like this might come, I know you may not have the granular understanding of our particular MSA, but again, we're under 1 million, rapidly growing, primarily suburban, and much of it is corporate and quality of place driven. So, and institutional, we have a university and a couple of colleges here. So based on what you know about these smaller markets, what do you see over the next 2 to 3 years for us?
Well, I did study your market before. I just read the Moody's report about Northwest Arkansas. So I am at least marginally prepared, and I do have my cousin-in-law who's from Little Rock, so I've got that too. You mentioned all of the key elements that matter to me. One of them is you have positive demographics. I was looking in the Moody's report. Your population skews younger, which is great because that will drive spending. Number two, having these great corporate base is obviously enormous because that's the level of stability you need to create a multiplier effect for jobs. But the university thing is key. It's really, when I talk about markets that I like, I use this tool, which I call the 5 factors of awesome. And what are the 5 factors of awesome, right? I'm going to probably forget one of them now, but work with me here. It's talent, live, work, play, ease of doing business, foreign money, and infrastructure. See, I got all those, right?
Nice.
And so the number one among them is talent. And what was interesting today, Mark Zuckerberg, the CEO of Facebook, came out with an announcement yesterday and said that his employees are now free to live anywhere. And what is he looking for? Talent. Yeah. And if you're an employee, you got talent, and you want to live at half the price of San Francisco, it might even be less than half, looking pretty attractive to me. So what I'm suggesting here, I'll say it again, I'm not suggesting that Little Rock, Arkansas is going to have a competitive advantage forever. I'm not saying that. I don't want to mislead you, but you have a modest competitive advantage right now. The iron is going to be hot for the next couple of years, and you can exploit that if you really leverage off of the Fortune 500 companies, the talent base, the low cost of living, and I would really focus in on infrastructure, which is another one of my 5 factors of awesome, particularly as it relates to 5G and other types of technological internet connectivity, because speed is going to matter. If you can have great 5G and other types of technology there, that will be the, okay, we're coming.
Yeah, that's excellent. So I think you will find positive reception to that message here. We definitely believe, I think the overarching theme for our moment right now in the economic development scale is it's the heartland's time. And for many of the regions you just mentioned, we see people choosing to live here for affordability, quality of place, but also because they can still access the bigger markets thanks to technology that we have.
More now than ever before. Yeah. It's not just accessing them, it's accessing them with the blessing of some of the big CEOs.
Yeah, appreciate that. So another question here about food halls. You spoke about the experience retail, right? And in particular, the experience of food. It's not a clinical transaction these days in terms of seeking dining. It is the experience, and food halls were really having a moment throughout much of the country. We saw them becoming popular attractions and generating high volumes of foot traffic, but with social distancing measures heightened, what are your thoughts about these food halls, these higher density, foot traffic driven experience food hall environments?
Not dissimilar than other high density experience uses like movie theaters or ball games. They're going to have a short-term problem. The short-term problem is they're going to only be able to operate at the way Texas opened up, and Texas is about as pro-business as you're going to get. They opened up at 25%. And then they're going to go to 50%. Do they get much above 50% capacity until we have a material improvement in the medical situation? I'm not sure. And so what's going to happen is these food halls are going to have to come to some kind of accommodation with their landlords on rent in the short term, number one. And number two, I was on the phone yesterday. When I was on CNN yesterday, the guy that was on just prior to me was the mayor of Miami. And what he was talking about was, for anybody who's been to Miami, they'll know Collins Avenue, which is the one that runs right along the beach or just a block off the beach. And they're closing that. They're closing Collins Avenue indefinitely. Why? So that the restaurants that are pertinent right next to Collins Avenue can create outdoor seating for some period of time. And so Arkansas has the type of climate that would allow you to do a little bit of that. So doing some types of things with the parking lots and or the roadways nearby should be something that the local retail restaurant owners should be lobbying hard for right now, because your interior capacity is going to be limited until probably for the next year and a half.
Yeah. I think our audience is going to be happy to hear that they can look forward to that being part of the roundtable discussion for the coming hour of this event. Uh, I think we're going to talk about the use of space and how restaurants in particular are going to need to potentially redefine their use of space and how it supports their commerce while supporting social distancing, both perception and regulation. So,
But I want to be clear, this is short term.
yeah,
Now, 12 to 18 months is an eternity if you have a capital markets problem, don't get me wrong.
yeah,
But 18 months from now, I still think the future for food halls is very bright.
yeah. What do you see the difference between small retailers, locally owned retailers, and the larger national or regional brands? Obviously, access to capital and the ability to leverage equity or assets is going to be part of that conversation. But what are you seeing in terms of the, I guess the share, the rate of closures and small locally owned versus larger chains?
Well, to quote Jim Cramer, who said this yesterday on his show, it's a really tough sled right now for these smaller retailers. They are getting crushed, not only financially today, but they're losing market share, and it's hard to pick up market share again. And so, boy, it is tough. Whatever comes after this debacle,
Mm-hmm.
I would hope that small businesses get an extra leg up somehow to get back on their feet, because there's no way to candy coat it. The mom and pops, the smaller retailers, disproportionately got hurt in this.
Yeah. So a question here from a restaurant practice director at an engineering firm. Curious about the HVA systems, back to your wellness, which, by the way, I love to hear you talk about, because ULI has the Green Print Center, and Building Healthy Places is in our portfolio as far as education and research goes. So I know that the Building Healthy Places team up at ULI headquarters in DC would be happy to hear your assessment of wellness as a competitive advantage, a wellness environment as a competitive advantage. Here is our question about restaurant owners in particular using technologies like improved HVA systems. These things might not be on the forefront of customers' minds. And so for whether it's a restaurateur or a property owner choosing to make that investment, or potentially even marketing and communicating that investment such that it triggers in the minds of the consumer, because ultimately that's where, it's the consumer's confidence that they're entering a safe space that is going to get them to open their wallet. What are your thoughts on the level of investment, and then how to communicate that, make that part of the branding strategy?
Sure. So I'm going to answer this in a couple of ways. The first one, I'm just going to be off the wall because I just watched this movie yesterday while on the treadmill. So I was watching a movie yesterday called Public Enemies about John Dillinger in the 1930s. And there was a big sign outside the movie theater, and it said air conditioned. It had a huge sign, air conditioned. Remember, I mean, some of the folks on this call know what I'm talking about. People used to go to the movie theaters not because the movie was great, because they had good air conditioning. So, I mean, we're back to the future of 75, 100 years ago about that. So you could advertise this in more ways than one. But let me cut to the chase here. So I'm going to go outside the restaurant sphere, then I'm going to jump right back into it. So last year, and every year for the last 10 years, CBRE has written what we call our Green Building Adoption Index. And what it measures is what percentage of each building is green from a LEED or an Energy Star rating in each city. And so the number one city in America happens to be Chicago at like 75% of their office buildings are green, right? The number one building in America for green multifamily apartment buildings is Denver at 7%. I'm going to say that again. 75% office buildings, 7% multi, the two greenest cities. Retail may be even lower than that. And why? For exactly the reason you just laid out, Wes. People just don't know. Mm-hmm. And I'm going to go one step further. And this one's a tough one to swallow. This goes right back to the ICSC study I talked about before, about people being much more price sensitive than you think. People don't care as much as you think. They are going to say, well, if I got to go into this building, this restaurant, are you going to choose the one that has the better HVA system over the one that doesn't? You're damn right you are. Yeah. But not if your hamburger costs you $30 and the other one costs 10. So it's going to be this teeter-totter act as it relates to what you're going to do. But I would expect that you are going to see a material upgrade in HVAC systems and those people who use not only the forced air with the ultraviolet light, but those people who go all the way and go, I've got hydronic HVAC, we are the cleanest place possible, will have a competitive advantage. And then they need to determine whether or not that's going to drive market share. And I think it's not quite as black and white in the retail arena as it is in the office arena, where it is black and white, because you're not going to be able to attract any type of tenant or occupier if you don't have a green building, or it's very difficult to do so. But as noted by multifamily, why are they only 7%? Because a lot of people are saying, well, you know, green is great. What is it going to cost me? An extra $50? I'm going back to the other building.
Yeah.
And it's remarkable how people could say one thing in one arena and not in the other. And it all comes down to price wins, even at the expense of some other things.
Yeah, I appreciate that. Do we have time for just a couple of more?
Sure, go ahead.
Keep one robust one here, and then hopefully we can end it with a quick one. So question here about supply chains. Emerging pressure on supply chains will impact everything from manufacturing facilities and distribution centers all the way to local restaurants, grocery stores, and retail chains. What are the supply chain challenges that you see emerging, and what are the domino effects for real estate?
Sure. So if there was any one failure in this terrible tragedy from a commercial real estate standpoint, is that we became too efficient. Everything was just in time. And what happened was, when the system got hit by a massive shock, we had no resiliency. We had no redundancy in either inventory management or supply chains to be able to keep up for it. And part of that's related to the fact that a lot of the manufacturing was done in Asia and China, places like that. So it took longer. And that's why you're seeing some critical manufacturing coming back. We already saw an announcement by the Trump administration last week. A big pharma company is now going to be forming in Virginia to make certain types of pharmaceuticals. So implication number one is you're going to see some reshoring of manufacturing. That's going to take a while. And it's in the expression that my colleague Henry Chin used on me this morning was not leaving China, but China plus one. That is the new phrase that people, I want my manufacturing not just to be in China, but maybe in Mexico, maybe the US, maybe Vietnam, but China plus one is the most likely thing. China's not going anywhere. It's just too efficient to do business with them. But from a restaurant, grocery, retail standpoint, I had a call the other day with the CEO of a very large owner of cold storage. And a lot of people thought that, oh, we're going to need more cold storage because of the lack of food redundancy, or more people getting goods delivered to their homes. And so I guess a key question that's being asked here is, how much internet penetration are you going to have, not just for durable goods or dry goods, but also for non-durable goods, for food? And he said, we don't need much more cold storage than you think, because most of those kind of goods are still being shipped out of the back of your grocery store. And you might just need bigger grocery stores, because it's still more efficient to do it that way than it is to have a separate facility for those types of things. So some of the things that we assume we're going to need, millions of square feet of more cold storage, well, he wasn't quite as black and white on that. Now, we might need more square footage for last mile industrial, for dense urban environments to get goods to the market quicker. But I think you're going to see potentially larger grocery stores if we're going to see more internet penetration in the non-durable goods sector. But here, I want to be clear about something. While we saw hockey stick growth this year in internet sales, you're likely to see hockey stick growth downward. You're probably going to see negative growth in the internet in 2021, but it will be at a higher plane. We're not going to see this kind of hockey stick growth happening forever once people get back into their normal patterns. But it will bode for more last mile industrial, maybe marginally more cold storage, but bigger grocery stores. But for people who are writing the death knell of restaurants, not in this seminar, and not out of my lips, because I think the future is just as bright as it once was after we get through this 18-month period and with some enhanced wellness.
Well, I like to leave it right there on a positive note. It's hard to find those this day and age, so we'll let you end the meat of your presentation right there on a positive note. Before I let you go, I'm curious what your reading list is right now, whether it is, is it periodic journals? Are there particular blogs that you're turning to, market report, market analysts that you turn to? that are your favorites, or just your favorite fiction that's taking your mind off work these days? What's on your reading list right now, Spencer?
Well, I read everything, right? I like the Financial Times is my favorite periodical. The Economist, it's a tough read, but if you go through that, you're smarter for it for sure. But I like to read fiction. I like to watch, my binge watching. I've been watching a lot of old 1960s television shows. I don't know why I like 1960s television shows. I just do. Goofy things happen to your mind when you're stuck in your house for 3 months, but that's what I've been watching.
Outstanding. Outstanding. Well, once again, we certainly appreciate you being here.